Good evening to all of you. Wow, the stock markets have been really crazy recently, right? So I decided to hold this live Zoom session to share with you guys some of my thoughts and also some pointers to help you make sense of the markets, right? And learn what you should and should not be doing. Okay, tonight's session will be a pretty short one, which may take just about 30 minutes. So thank you for joining us tonight on a Thursday night. Feel free to send in your questions and I will do my best to answer them. Okay, I'll keep the Q&A towards the end of the session. Okay. All right, so the usual stuff. Okay, please take note that whatever I share with you guys tonight, please do not take them as financial advice or financial recommendation. Do your own due diligence as always. Okay, all these are just my personal opinion. Okay, so we have some of you who are attending this webinar for the first time tonight. Okay, so I'm Hazel, the co-founder of the Joyful Investors. Right, from time to time, we will be holding sharing sessions to share about investing tips and our take on the recent market events. So if you want to be in the loop for our future sharings, do keep a lookout for our social media, okay, our Facebook, Instagram, as well as our Telegram channel. Okay, so for those of you who have not yet joined, you can join our Telegram channel, Facebook, and Instagram. Okay, so in tonight's sharing, here is my focus. Okay, my focus is on two main parts. First is looking at the markets, which have caused many investors to freak out, right? And I will share with you what are some areas that I'm watching right now. Okay. Then finally, in the second half, I will be sharing some very important pointers that we have compiled for you on what you should and should not be doing. So all these are based on our observations of the current market situation and based on our observations of the reactions of many retail investors. Okay. All right, to start off, maybe can you guys let me know how has your portfolio been hit during this period? Okay, if your portfolio has suffered quite a bad drawdown, can you type BAD, bad, in the chat box? And if your portfolio has been doing very well and holding up well, type a good, GOOD, in the chat. Okay, you don't need to feel paiseh. We're all here to learn. If you really don't want others to know, right, you can just send it into, you can just choose to click panelists and hosts only. Okay, and you just send it to me, right? So if your portfolio has suffered quite a bad drawdown, then you can type a bad and let me know. Okay, if your portfolio has been holding up well, you can type a good. Okay, I see some of you sending it into me. Okay, bad. Okay, mostly bad. Rainer says bad. All right. Okay, mostly bad. Okay, then how do you think our TGI portfolio has been during this period? Do you think we have been impacted too? The answer is yes, of course. And I say this because I just want to reassure you that during times like this, almost all will be impacted. Okay, even if you are holding stocks of quality companies. This is pretty normal. Okay, the thing is knowing how to react. It is during such times when you realize you may initially think you have trained yourself well enough to take out all the emotions from the investments. But when shit happens in the market, fear and panic overwhelm many investors. The top risk concerning most investors right now is the geopolitical conflict between Ukraine and Russia. And it has been about 3 weeks since Russia launched attacks against Ukraine. Right? And every day we see news reporting on the latest development of the war, which Ukraine calls it a war, but Russia refuses to say that it's a war. And the economic sanctions on Russian oil imports that was put up by the West drove up the oil prices, okay, because Russia is a major exporter of oil in the world. The part that is worrying many is that historically, when there was a surge in oil prices, the US economy went into a recession and bear market. So this is something that has been worrying many investors in the market. Take a look at this chart over here. Okay, all these gray areas, gray bars, this represent the periods when the economy went into a recession. So when there is a sharp increase in oil prices, okay, you can see when there is a sharp increase in oil prices, historically, it has caused the US economy to dip into a recession, right? Except for the one for COVID crash, that's different. Okay, the oil prices went down. Okay, but the situation was different as well then. So the question now is it going to happen this time around as well? Is it going to happen? Are we going to have a recession? Well, I really have no idea. Just like I didn't predict that there will be a war at the start of 2022 when I did my stock market outlook sharing in January. Over the last 1 month, the markets have been choppy. The Nasdaq had previously hovered near the borderline of a bear territory. But as of the last close, which was yesterday night, okay, as of the last close, it has closed up higher, okay? And year to date, Nasdaq is still down by about 14%. So with all these volatilities and pullbacks in the market, does that mean that we are going to a recession already? It is never easy to predict whether there will be a recession coming because there are many factors that are affecting at the same time. One argument for that there might be a recession is by looking at the surge in oil prices. Surge in oil prices will bring about higher prices for the goods and services which require oil as part of the production, because the manufacturers, they may pass on this higher cost to consumers, and then that may impact consumer buying activity. And in addition, when consumers spend more on such products, they will have less money to spend on other goods and services. So that is one argument as to how it might be detrimental to the overall economy and how it might eventually lead to a recession. So that is one argument. But we have a counter argument. The counter argument is that so far, the consumption activity has been pretty resilient and healthy, coupled with the reopening of economies, okay, pent-up demand with more travel and more leisure activities as the effects from the pandemic are finally fading. So this is a chart by JP Morgan, which shows that the consumption is still resilient, okay? Taking 2019 as a reference, okay, you can see that the consumption here has been pretty resilient for most of the areas, okay? So can this pent-up demand offset the cutback of consumer spending due to the rising oil prices? This is something that might play a factor in whether we will be facing a recession soon. But again, the answer to this question, no one will be able to answer, and only time will tell. Okay, but I just want to bring up this point to let you know that it is not a for sure, recession is definitely coming, okay? Because there are many factors that are affecting, and there are many factors that are changing at the same time. Okay, so we are not that sure that, there will definitely be a recession. Another area that remains unknown is how the Fed's monetary tightening policy will be, which will also impact the eventual outcome of whether the economy might go into a recession or not. Right? We have the Fed announcing the first rate hike of 0.25 percentage points, which is 25 basis points, just this morning. Okay, this is just in only. And the Fed also said that they expect rate hikes at each of the remaining 6 meetings this year. But again, there is still unknown elements as to how the economy is going to react to these rate hikes and the subsequent rate hikes, which will also influence the eventual rate hikes to come. Okay, nothing is cast in stone for the future moves by the Fed. They said that yes, for the remaining 6 meetings, they expect rate hikes. But again, nothing is cast in stone. Okay, it also depends on the reaction of the market, of the economy, how it's going to react to all these rate hikes. All right, so the world is very complex. It is a product of many variables happening at the same time. Okay, so just like for example, today, Xiaoming, he may be craving for chicken rice. So he left his house to buy chicken rice for dinner. But who knows what might happen during the journey? Xiaoming might walk past a new pasta shop. So he decided, okay, I want to try this new shop. Maybe it will be nice. Or another episode might happen. As he was on his journey to the shop, he might have tripped and fell. He sprained his ankle, so he hit home without the chicken rice and decided to cook instant noodles instead. So do you realize that all this lead to one conclusion? What is it? That is, there is no point trying to predict whether the market is going to crash or whether a recession is coming. And there is no point putting yourself into this stress up mode or this very panic mode that a recession might be coming. Because I have seen many contents online that talk about how a recession is coming, how recession is really coming this time, and they end up inducing a lot of fear for the audiences. Even if a recession really does come, because I can't predict, there is also no need to cry over spilled milk. What matters the most is, do you know what you should do next? What has happened is something that is out of our control. Instead of focusing your attention on things that you cannot control, focus on what you can control, which is what you should be doing, right? We never like to induce fear in our community. For those of you who have been following us for some time, you may realize by now that we do not try to cover every single market event that comes up, just so to increase our engagement. Because what really matters in investing is not the news. It is not what event is happening in the market. I will share with you in the second part later on, what is it that matters. And to make things worse, the media in each country is mostly controlled. There is propaganda, whether is it in the Western media, whether is it in the Ukrainian media, or is it the Russian media or the Chinese media. So reading the news about the development of events do not help us in understanding the true impact of the stock markets or what is really happening out there. Okay, because there is propaganda. The media is controlled to a certain extent. All right, so I don't know if there will be a recession coming along, and I don't want to be predicting just so to feed you an answer because it is anyone's guess. But I want to share with you what I will be looking out for and the pointers on things that you should be doing and should not be doing. Let's take a look at the charts, the stock charts. Okay, I like studying stock charts because stock charts can tell us the general sentiments of the market participants. Take a look at this stock chart for S&P 500. Okay, let me explain to you. So if you can see over here, there is this very long green color bar, which we call candle. Okay, by the way, for those who are not familiar with stock charts, all these red and green bars, they are called candles. Okay, and they represent the prices that are transacted within the day itself. Okay, because I'm looking at the daily time frame chart for S&P 500. So I would like to point your attention to this green color long green bar over here. Okay, this is the price for 24 Feb. It was the day when prices actually dipped lower than the previous low. Okay, before that, this was the low. But after 24 Feb, this is the new low. Okay, it dipped lower, but the bulls came in and they found momentum. and we ended the day with a very long bullish candle, which signals bullish sentiments of the market participants. But this bullish momentum seems to have weakened because the prices, after this, it came back down again. Okay, let me erase all this. Okay, maybe I will use blue color. Okay, so this was the day itself. Okay, there was bullish momentum, but the prices came back down again as the momentum seems to weaken. And if you try to draw out the wave patterns for S&P 500, you can see that the prices are actually making lower highs and lower lows. Okay, let me draw out the wave pattern for you. Okay, you can see here the wave down. Okay, then it goes up, then it comes down again, it goes up, and it comes down again. So this is the low. Okay, this is the low. It is, and this is another low. So it is making lower lows. This was the high. Okay, and this is what we call high. You can see that the prices are making lower highs as well. So what does this mean? Lower highs, 1, 2, 3. Lower high and have a lower low, 1, 2. What does this mean? This means that the S&P 500 is in a short-term downtrend right now. Short-term, okay? But the long-term uptrend is still intact. Okay, if you zoom out in time and look at a wider time frame, the uptrend is still intact. But in the short term, very short term, the S&P 500 is currently in a short-term downtrend. So since then, what I have been doing is I have been watching this price level, which I name it as level A, key level A, very closely. Okay, why? Because if prices can find support at this key level A, if prices can find support at this key level A, in other words, if prices, when you retrace, it can find support at this key level A, then we might see some more bullish momentum coming. Okay, 3 days ago, which is, okay, might be very small, somewhere here, this red color, small bar here, on 14 March, we saw that the prices actually hit very near the support level. Okay, but it did not break below this support level. So that was something positive to see. So for the remaining of this week and come next week, what I'll be watching closely is whether this support level A can still hold. If it does, then the bullish momentum is not broken yet. Okay, and on top of this, other than looking at A, there's another level which I'm looking at right now, which is level B. Okay, as the prices, you see, yesterday and the day before, the prices actually shoot up. Okay, so I'm watching this level B right now very closely because this is a very strong price level that might become a new resistance for the S&P 500 in the short term, which means that prices may come here, hit this level, and it might come back down again to find support at this level. So if prices, I'm going to see how prices are going to react when it comes to this level. If prices can manage to shoot up above this level, break above this level, that will mean that we have an even stronger bullish momentum. Prices may be going back up already. But there is also a very high chance that this might be a very strong resistance level whereby the prices will hit this level and it will come back down. So this is another level, level B, that I'm looking out for. Okay, so these are the two levels that I'm watching very closely for the remaining of this week and for the next week to come to see how the S&P 500 is going to move. Okay. As for NASDAQ, what about NASDAQ? For NASDAQ, we're actually looking at very similar price movement as well. Likewise, you can see that there is this very long green bar over here. This is also on 24 Feb, which was the day when the bulls came charging in. So similarly, a level that I want to look at is this level, which is the previous low, which is the level whereby we had the previous low. I'm going to see whether prices can still find support at this level, which means to say it will either test this level or it will be above this level. Okay, I don't want prices to break below. If prices break below, it might mean that there is more bearish momentum to come. Okay, so previously you can see that on some days the prices did test this level. Okay, but eventually what is very positive to see is that it went back up again. So that is something bullish to see. It is a good sign. So level A is a support level that I will want to be watching. And likewise, I also have a level B here. Okay, based on the situation, based on the price action right now, this level might also become a resistance for Nasdaq. So again, if prices do break above this level B, that will show a stronger bullish momentum for Nasdaq. Notice that I'm using the word might because there is no 100% guarantee when we read the chart movements. Just like there is no 100% guarantee on how the war will progress, or whether there will be a recession, whether the S&P 500 will dip into a bear market, there's no 100% guarantee. But when we learn to read charts, it can tell us some information on where the market seems to be going or might be going, okay? So these are some of the key levels that I'm looking out for this week and for next week to come. Okay, and we'll be able to see where is the S&P 500 and where is Nasdaq moving to. On top of this, this is another thing that I'm looking out at. During my previous Zoom sharing in January, when I did the 2022 stock market outlook, I shared with you guys this indicator. So for those of you who have joined me in that session, you will be familiar with this spread between the 10-year U and the 1-year U. Okay. Other than this one, another one that you could be using is the spread between 10-year U and 2-year U. Okay, you can use both of this. How it works is this. If the spread, that means if this graph, this chart goes below 0%, okay, this is 0%. If it goes below 0%, okay, it is an indication that a recession might be happening. So these were the previous indications during the previous 7 recessions, right? This spread between the 10-year and 2-year U have successfully predicted the previous 7 recessions that have happened. So I will be watching this very closely because this has proved to be a very strong and rather accurate indicator so far, based on history, based on what has happened in the past, right? So right now, how is the spread like? Okay, right now, if you see here, there is this 0.27%. This is the current figure. It's at 0.27%, right? And this data is accurate as of 14 March 2022. Okay, so the numbers have fallen since January, but it is still in a positive area. So this is one indicator that I'm watching very closely, right? And remember I said predict, right? Because what happened over the past recession is that when the spread becomes negative, recession does not happen immediately on the day itself. No, it is not like this. It took some time before recession happened. So in the event, if we see the spread goes to negative, right? In the event we see the spread goes to negative, don't have to panic. Recession may not happen immediately. It might take some time before recession happens. Okay, because this is you can consider it as a leading indicator. Okay, so based on the factors we have right now, we cannot be sure to say that there will be a recession. So don't scare yourself out before anything even happens. All right, because I have seen so many contents online that cover about how a recession is coming, and that really induced a lot of fear for retail investors. In the event if a recession really does come, you also don't need to panic. Because always remember, what matters the most is you need to know what to do. That is the most important thing, because that is something that you can control. Whether recession is going to come or not, that is something that's out of your control. There's no point worrying about something that's out of your control. Focus on what you can control, which is what should you be doing, right? So more importantly, I'm now going to share with you some of the key pointers that we have put together for you guys on what you should and should not be doing. So all these are based on our observations of the markets right now, and based on what we see, many investors are doing right now. So some of things that we want to point out to you. The first one that I have on my list is never chase after shiny objects or investments that seem to be able to make easy money for you. During this period of heightened geopolitical tensions between Russia and Ukraine, I've seen many contents online advocating the rotation of funds into commodities. There is nothing wrong with investing in commodities, and I'm not saying that commodities are bad investments, but the problem is many investors, they are blindly jumping into commodities without really understanding what they're investing in. And why they are investing in commodities is purely because the Russia-Ukraine conflict is driving up the prices of commodities. So they see this as an opportunity to make easy money. Never invest based on market events or based on the news. If you do that, a lot of speculation is involved, right? A lot of speculation is involved because you can never be sure that you can predict when exactly this event will end. When will this event end? When will it cause the prices to move back down in the opposite direction? When you try to invest and shift your funds around according to the timing of the market events, here are the risks that you are exposing yourself to. Number one, failure to exit the investment in time. During times when there is a seemingly bad event happening, a bad event that is taking place, it usually will result in more volatilities in the financial markets. And if you do not learn how to read the charts, if you do not learn how to read the sentiments properly, it will be challenging for you to find that right timing to exit the investment and take profits. And this failure to exit the investment in time may cause you to lose all the paper gains that you once enjoyed. And the worst case scenario is to end up losing even more money, right? Because you jump into this investment based on this event. The prices are going up for this investment because of the current event. But if you don't know how to read charts, you wouldn't be able to identify a good exit point. You cannot exit on time. And the risk is that you may end up losing even more money than what you wanted to earn in the first place. So this is the first risk if you chase after all these shiny objects that seem to be able to make easy money for you. The second danger lies in your psychological mindset. Very often, some investors have this mindset. Right? If you look over here, some investors, they have this mindset. When they're at this point, they will think to themselves, okay, I will wait until the price increase to X level. I'll wait until the price increase to X level, then I will sell. But when the prices hit X level, that is when they start to change already. They'll think, no, I'll wait a little more, just a little bit more, and I'll sell at Y level. This is when human greed comes in. They start to shift their target price level to Y level. Okay, and they will say, I'll just wait a little bit more, just a little bit more to go. When prices eventually really reach Y level, they start to shift up this target again to Z level. It is never ending. And before you knew it, the prices start punching down again really. Because this is an investment that involves a lot of speculation in the first place. Okay, you don't even know what you are doing. Why are you buying this? And you don't have a proper plan. You are just shifting your price targets around because of human greed. So this second risk is the risk that lies in your psychological mindset. Human beings are naturally vulnerable to our psychological mindset, to emotions and our psychology. So never do things like this, okay? Shifting your funds around just because these investments right now seem to be able to make good money. Never do that. Stick to your investing plan, right? Why all this is happening is because this investment was a speculative one to begin with. It was based on speculation in relation to a particular market situation. So generally, volatilities will be higher in the short term, and you may see bigger price swings that happen very quickly. Sometimes within just one day, you could start off with very bullish price action, and you end off the day with very bearish price sentiments. All these are possible because usually when you have all this kind of events happening, there will be more volatilities because there's more uncertainties. Human beings are more susceptible to fear, greed, emotions like this. Okay, so never do that, right? If you're a long-term investor, please do not jump in and out of your investment, right? Just because they seem to be very popular themes right now. Never do that. Never jump in and out of your investments based on the market events. That is not the right thing to do. Today, if you are a trader, okay, then you may benefit from the price action that comes with such market events. But trading is a different story from investing. So if you're a long-term investor, please do not do this, right? Please do not do this. The core message that I want to pass to you guys is that as investors, never chase after shiny objects, thinking that they can help you to make easy money just because of this market event that is happening or that market event that is happening. Okay, we'll still dabble with investments that are out of your circle of competency. Never invest in things that are out of your circle of competency just because they seem to be very popular right now. Okay, so this is the first one that I have for you. Instead of doing all this, instead of investing based on events, based on news, always invest based on the fundamentals of the companies. This is the #1 investing principle that will never change. Okay, this is the #1 investing principle that will never change and that will never betray you. Invest based on the fundamentals of the companies and stick to your investing plan, regardless of the noises out there in the markets. From time to time, there will be events happening in the markets. Okay, some having a smaller impact on the stock market, some resulting in a bigger impact on the stock market. And you've got to understand that this is actually perfectly normal. This is perfectly normal. Take a look at this image over here. You can see that over the years, there's so many events that have happened. Some like Cold War and all that. All this that have happened. But eventually, the S&P 500 still went up. And in fact, this picture alone, it only shows some of the event. There are many others that are not within this picture itself. So it is perfectly normal to have such events happening from time to time. Okay, so don't panic because of this. Each time, the news make it seem as if like it is the end of the world, that this is the worst crisis ever in history. So when you read news, you have to read them with a pinch of salt. Sometimes they may use language that try to sensationalize things, okay, but never invest based on the news, right? Never let the news affect your investment decisions, okay? Because every time they will try to portray it as if it is the worst crisis ever, as if you will think that the stock market is going to crash and that it will never recover anymore. But nonetheless, you see that the stock markets recover eventually. If you take a look at the S&P 500, this is the chart of S&P 500 over the years since 1991 until now, right? It is a nice uptrend. The S&P 500 eventually always recover, right? This is a period over the last 30 years. You see a very nice uptrend. And of course, sometimes when I show this kind of chart to investors, that might also give investors a wrong expectation that things are always rosy in the stock market. Over the long term, yes, things are good, but in the short term, anything can happen, right? If you look over here, this timing was the dot-com crash. This was the 2008 financial crisis. But if you look at a smaller dip, right, we don't look at crashes, we just look at smaller dips here. If we zoom further in time to look at this circled small dip, you can see that the price swings are equally crazy. the price swings are equally crazy. This is the one that I have zoomed in for you. Okay, for this small circle region, you can see that we have pullbacks of more than 15%, more than 20%. So in the short term, anything can happen in the market, and there will be volatilities. There will be corrections, 10% or more happening. What we are experiencing right now in the stock markets, what we are seeing right now for the stock markets, is not anything that is out of the ordinary. Okay, in the short term, there will always be volatilities. But over the long term, you can see that the S&P 500 managed to always go up, a very nice uptrend. So you don't have to worry about all the short-term fluctuations, because if you are investing in the right investments, eventually they will give you the returns that you deserve. Okay, so to do well in the stock markets, you must be patient. The best investors in the world are patient in the stock markets. Take a look at Warren Buffett. He never jumps recklessly in and out of the stock markets. When he buys stocks, he is in for the long haul. And this is what he said. You've got to be prepared when you buy a stock to have it go down 50% or more and still be comfortable with it, as long as you are comfortable with the holding. So if you're able to embrace the concept of delayed gratification and patience, you will make a good investor with the right temperament. Right? In the short term, anything can happen. The news are going to paint a very bad picture to make you get very panicky and very stressed up. But if you are buying the stocks of good companies, eventually the returns will go to you. One of our favorite stocks is Adobe. It is a fundamentally sound company that has very good growth potential, and it has exhibited very strong financial track record over the years. But even a company, a quality company like Adobe, is not spared during this period. During this period, right, year to date, Adobe has been down by more than 20% since the start of 2022. So does this mean that Adobe is really worth 20% less than what it was worth back in 2021? No. In fact, the fundamentals are still the same as what it has been 3 months ago or 4 months ago, right, when it was here. It has still been the same. The fundamentals have been the same. The fact that the price dropped by 20% does not mean that the stock is really worth 20% less than what it was worth back then. As investors, we need to be very careful. Don't mix up irrational mispricing of stocks with its true worth. There is a difference. Irrational mispricing of stocks and its true worth. Don't mix them up. Very often, the pricing in the short term is influenced by sentiments, by speculation, by irrationality, or even by manipulation of the bigger players, those who have very big funds, right? They can move the prices. So this current mispricing of the quality stocks like Adobe do not speak about their future outperformance. I want to give you another example. Amazon, right? It is another quality business with good growth over the years. But do you know that in 2021, last year, the total returns for the entire year of 2021 was only 4%? For the stock price, it was only 4%, right? It started somewhere around here, right? And it ended somewhere around here. So it's almost flat, about 4%. In comparison, the revenue and the earnings, they have grown by more than 20% in 2021, which was very good results. But how come the stock performed fared so poorly? Because in the short term, there is always irrational mispricing. Right. Then there's another crazy thing that happened. So on, which day was it? I cannot remember the day itself, but it was very recently. Amazon announced a 20-to-1 stock split. And when the news was released, when the news was announced, the prices shot up over 6% in the after hours. Okay, you take a look at this circled 6%. This is the after hours. It shot up over 6%. Then when the normal trading hours open on the next day, it also shot up by a lot. Does this make sense? No, it doesn't make sense because a stock split does not change the value of the stock to an investor. If you were holding one Amazon stock initially, right now after the split, you will have 20 Amazon shares. But because the stock price will also be split by 20 times. So what it means is that the total value of your investment in Amazon did not change at all. So fundamentally, the business of Amazon after the stock split is still the same as the business of Amazon before the stock split. So this is another good example that in the short term, the pricing of stocks are often due to sentiments and irrationality. But over the long term, the stock prices will eventually reflect the true worth of the stock itself. And I just want to prove this to you by going back to the stock chart of Adobe. I've taken some screenshots of different periods to show you that, this is the chart from 1986 to 2002. It is a very, very nice long-term uptrend. But within the short term, you can have pullbacks of 25%, over 20%, over 15% in the very short term. Even for a good stock like this that has a very nice long-term uptrend, in the short term, you can experience fluctuations that are as big as 20% or even more than 20%, right? But don't worry, because eventually over the long term, it has a nice long-term uptrend, which aligns with the strong fundamentals of Adobe. So in the short term, there's mispricing, but over the long term, it will still go back to what it is worth, and it will align with its strong fundamentals. So if we learn how to capitalize on the pullbacks to add some positions of the quality companies, you will be able to reap a good return from these great opportunities. I also like to show you some calculations. Take a look over here. If today the stock price dropped from $200 to $150, that is a 25% drawdown, right? Because 150 minus 200 divided by 200. But if you learn to capitalize on the opportunity to buy the shares of this good business at $150, right? When the price dropped to 150 and you buy and you hold it until prices revert back to previous levels, this is what you will get. You get 33%, not 25%, right? You get 33%, not 25%. So it's such a great opportunity. Let me show you another one. If prices drop to 100, that is a 50% drawdown. But if you buy it at 100 and you wait for it to recover eventually, that is a 100% gain. Okay, I'm not doing any magic to the numbers, okay? All these are pure mathematics. The point that I'm trying to show you here is that if you learn how to make use of each correction or each price pullback in an appropriate manner to buy stocks of the quality companies at a bargain, it is possible to make very good returns in the stock markets over the long term. So you need to learn how to capitalize on such pullbacks. They are not crises, actually. They are opportunities if you know what to do. So always stick to the fundamentals and always invest based on the fundamentals of the companies. They will reward you in due time over the long term. During the good times, everyone feels excited to stay in the markets. Everyone wants to stay in the markets to earn money. But when prices decline, it is when the real test begins. Many investors, they will start to get off this ride because they cannot endure through the volatilities. I have also told some of my inner community before that it is such times when you actually get to learn the most from the stock markets. It is also such times when you are able to truly experience how it feels like to be in the stock markets, and that you can then adjust your expectations of investing. Okay, investing is not like how it is in 2021. 2021, the S&P 500 went up by a lot, but that is just, I would say, an abnormal year. Okay, most of the time you don't get such good returns for the S&P 500 in a single year, right? So very importantly, you need to set the right expectations. Okay, I know I have overshoot my 30 minutes, but let me go on with the last tip that I want to share with you guys tonight, which is the importance of setting aside cash at the sidelines. I'm not referring to emergency funds, all right? Emergency funds, they are called emergency funds for a reason, and they should not land in your investment accounts. Cash at the sidelines, they are the cash that you set aside so that you can fund into your investment accounts when needed. And these are the money that you don't need for short-term consumption needs. So for investors who throw in all the cash that they have, that they can possibly afford to put into the stock markets, they will not be able to tap on opportunities when the stocks go on sale in the stock market. I'm not saying that this is a mistake, but rather I think this is a choice, right? Do you realize that investing in the stock markets is like playing a game of board game? For those of you who play video games or games on the phone, you realize that in many games that we play, we are frequently in a situation where we only have limited resources. But we have to think if we should make this move or if we should make that move, or sometimes just give it a pass to conserve our resources for the next turn. This is very similar to investing, which is why I said if you do not have cash at the sidelines, I don't constitute this as a mistake, but it is more of a choice. And along the way, I realized that it is something that I want to have because I want to be able to tap on all this supposedly crisis, but which I view as opportunities to buy the good stocks at bargain prices. So that is one situation in which you will need to use the cash at the sidelines, which is to be able to buy stocks during price decline, right? The second situation in which you will need cash at the sidelines is when you have to fulfill a margin call. This may happen when you are dealing with derivatives in a portfolio. And so during the bad times, that may result in bigger fluctuations in your portfolio during market pullbacks. And you may need to top up cash to your investment account to avoid getting a margin call. If you don't have enough cash to top up, then you can only close off your existing positions to meet that margin call, which means that you have to realize the losses of your existing positions. So that is something that we would want to try to avoid, right? So having some cash at the sidelines would come in handy during such times when you need this money, right, to fulfill a margin call. So these are the 3 pointers that we have gathered from the recent market events and based on what we are seeing right now in the markets. For those of you who are already in the markets with exposure and positions in the markets, it might seem like a very painful time for you right now. But every time after a crisis and you look back at what had happened, you will come to appreciate that they are actually just small blips in the stock markets. Okay, just like this chart over here, the dark blue represents all the bull times and the light blue represents the bear markets. So all these bear markets are just very small blips over the very big picture, right? Remember, your worth should not be judged based on the short-term performance of your investments. In the short term, anything could happen. Nobody predicted that a war would happen. But if you have the right skills, if you have the right temperament, and you're doing the right thing, these are what will eventually bring you further in this journey. And this don't just apply only to investment, but it applies to anything that you do in life. Okay, so I hope that what I have shared with you in this session has been helpful for you, okay, in understanding what you should be doing and what you should not be doing, okay, because you never want to be making stupid mistakes during such times that can cost you a lot of money, okay. Thank you for joining us in tonight's session. Right, stay invested joyfully in the markets. And I hope that you have learned something from my sharing tonight. I've exceeded the 30 minutes that I said.